Assalamualaikum to our lecturer, Madam Hasmah Laili Jamalurus, and our fellow classmates. My name is Nur Ashikin binti Ghazali, along with other members, which is Nur Aliah binti Ramli, Nur Syazwani binti Nordin, and Nurisma Hazimah binti Ismail. Now we are going to present a topic about an Islamic Takaful. Takaful literally means joint guarantee, shared responsibility, shared guarantee, collective assurance, and mutual undertaking, which reflects a reciprocal relationship and agreement of mutual help among members in a particular group. Thus, there are three aspects of mutuality embodied in Takaful, namely mutual help, mutual responsibility, and mutual protection from losses. So, Takaful is a system whereby participants contribute regularly to a common fund and intend to jointly guarantee each other, that is to compensate any of the participants who are inflicted with a specific risk. It is similar to a mutual insurance in spirit, but inclined more towards commercial insurance in its business endeavor. When a person participates in a Takaful scheme, he does not only seek protection for himself, but also jointly cooperates with other participants to mutually contribute to one another in case of need. Historical development of Takaful. The essence of Takaful could be seen in the system of mutual help in relation to the custom of blood money under the ancient Arab tribal custom, and was eventually approved by the Prophet ﷺ. The basis of shared responsibility in the system of Aqilah as practiced between Muslims of Makkah, which is Muhajirin, and Madinah, which is Ansar, aided the foundation of mutual insurance. This practice was then followed by the Prophet's companions. Aqilah is non-commercial in nature and is aimed at helping those in need without demanding contractual payments. Instead, it is motivated by the sense of brotherhood and mutual responsibility to help fellow members of the tribe who are in need of contribution. For instance, in this case of an unintentional murder involving two different tribes, the accused person's paternal relative will be the responsibility of paying the blood money, which is pulled from the group member contributions to the victim's relative. There are three phases of Takaful evolution. The first one in 1979, which is the first Ta'awuni model cooperative, was developed in Sudan. Next, in 1984, the Mudarabah model was developed in Malaysia, while the Wakalah model was developed in the Gulf. And last, in 1996, the Wakalah model with Wakaf Fund model was developed in Pakistan.
The difference between Takaful and conventional insurance is rooted in the type of contract adopted. The insurer pays regular installment, which is premium, in return for the guarantee to pay compensation if the event stipulated in the contract does happen. It is thus a probabilistic contract since the compensation is contingent on events that may or may not occur. This definition and nature of conventional insurance invoke a number of Sharia issues. Takaful participants mutually insure one another. This is the essence of Takaful that signify mutual guarantee, help, and cooperation with one another. The Takaful operator simply functions as the administrator of the fund. Its responsibilities include managing and investing the fund according to Sharia compliance. For contract type, Takaful is a combination of Tabaru contract and profit-sharing contract, while conventional insurance is an exchange, sale and purchase between the insurer and insured. Takaful participants are duty-bound to make contributions to the scheme and are expected to mutually share the surplus, while policyholders for conventional insurance are duty-bound to pay premiums to the insurer. Obligation of the insurer or operator is to act as administrator to the fund and pays benefit from it. If there is any insufficiency in the fund, the Takaful operator must provide interest-free loans to rectify the deficiency, while operator for conventional insurance is liable to pay the benefit as promised from insurance. Takaful operator earns a return from rendering service of managing program, while insurance company makes profit when there is underwriting surplus. Counter value for Takaful is iwat, the effort undertaking of the risk, while conventional insurance has no clear valid counter value. Indemnification component is based on mutual contribution and reciprocal donation, while indemnification component for conventional insurance is a commercial relationship between the insurer company and insured. There is no insurer-insured relationship between Takaful operator and participants, while there is a clear insurer-insured relationship for conventional insurance. Takaful fund must be invested in Sharia compliance instrument, while conventional insurance has no restriction on the investment.
I'm going to explain about the classification of Takaful operation. In general, there are two types Takaful, which is General Takaful and Family Takaful. Basically, the General Takaful contract is normally a short-term policy where Takaful participants pay contribution and operators undertake to manage the risk. The contribution paid by the participants are credited into the General Takaful fund, then invested, and the profits generated are paid back to the fund. The tabarruk element is more apparent in General Takaful, as participants will normally undertake to regard their contributions as donation to fellow participants. Also, there are no savings and investment elements, but the Takaful operator will distribute any underwriting surplus to the participants on an annual basis. Takaful operators typically provide a full range of General Takaful products in both retail and corporate segment. General Takaful is categorized into two types, which are Motor Takaful and Non-Motor Takaful. Motor Takaful provide protection for private cars, motorcycles, and so on. On the other hand, Non-Motor Takaful coverage range from fire, personal accident, and marine. Apart from that, Family Takaful is a long-term policy for which most participants aim at saving for their long-term needs. In Family Takaful, operators normally divide the contribution into two parts. First, the participant account, which is saving account, and secondly, the participant special account, which is tabarruk account, for meeting losses of fellow participants. Both contracts are invested in Sharia-approved securities. Family Takaful is loosely comparable to conventional life insurance. For example, if a participant dies prematurely, his family gets the amount in the participant account plus the dividends and the amount in the participant's special account as if he had continued contribution until the end of the maturity period. Basically, Family Takaful products offered are savings and educational plans, retirement plans, and so on. There are 4 Takaful models operated worldwide, which is Mudarabah model, Wakalah model, Waqaf model, and hybrid models. The first Takaful model is Mudarabah model. Mudarabah means the giving of capital to another person who will invest it for the purpose of sharing the profits according to a pre-agreed ratio. In Takaful, the capital providers Rob Al-Mal are the participants and the investment manager Mudarib is the Takaful operator. The investment manager must invest in a Sharia-compliant manner and according to the terms in the Takaful contract. The Mudarabah model is suitable for shorter terms products such as motor insurance, where the sharing of surplus takes place much earlier than the long-term businesses. Besides that, the second Takaful model is Wakalah model. Wakalah is a contract of agency whereby participants remain the actual owners of the Takaful fund. In this arrangement, the principal is the participant while the agent, wakil, is the Takaful operator. The principal appoints or authorizes the agent to manage the Takaful fund for 2 main duties, namely Takaful activities such as underwriting, and paying claims, and investment. As an agent, the operator is entitled to an agency fee, agent remuneration, and performance fee as agent commission. Currently, this model is widely used, for example, by Bank Al Jazeera in Saudi Arabia and Takaful Ikhlas in Malaysia.
Assalamualaikum, my name is Nur Aliah binti Ramli. I will continue with the third model, which is Wakaf model. Wakaf means a unilateral contract to hand a right over property and allocate it for general enjoyment of the usufruct by the specified beneficiaries. Wakaf is a financial endowment established under Islamic law, held in trust and used for charitable or religious purposes. It can be made applicable in the treatment of a takaful fund, while management and operational aspect of the takaful fund may still use wakalah and mudarabah models. Participants will give contributions into a wakaf fund and thus completely lose their right over their contributions. The takaful operator acts as a trustee to the wakaf fund, and the object of the wakaf is usually non-perishable properties in which benefit and usufruct can be extracted without consuming the property. Now let's move on to the hybrid models. There are three of them, which are hybrid of wakalah and mudarabah, hybrid of wakalah and wakaf, hybrid of mudarabah and wakaf. Number 1. Hybrid of wakalah and mudarabah model. This model combines the features of both wakalah and mudarabah models. The wakalah principles is applied in the underwriting activities, while a mudarabah contract is used in the investment of the takaful funds. Thus, the takaful operator is entitled to both an agency fee for managing the fund as a wakil and a share of the profit for managing the investment of the fund as a mudarib. Number 2. Hybrid of wakalah and wakaf model. In this modified wakalah model with wakaf, the relationship of the participants and the operator is directly with the wakaf fund. The operator is the wakil of the wakaf fund, and the participants pay one-sided donations to the wakaf fund, but it is not conditional and become members. In this model, the shareholders of the takaful operator will initially make a donation to establish the wakaf fund. The fund will be invested in Sharia-compliant investments, and the returns will be used for the benefit of the participants. The tabarruk fund from the participants' special account also becomes part of the wakaf fund. Number 3. Hybrid of mudarabah and wakaf. The plan is designed to enable any individual to save regularly with the objective of accumulating a fund that can be left as a donation under the wakaf system. Through this plan, the participants accumulate a considerable sum of money by making regular takaful contributions over a certain period of time, which would then be sufficient to be endowed as a wakaf. Benefits payable under the plan, either upon its maturity or unexpected death of the participants, is to be remitted by the takaful operator to the wakaf recipient. That's all from me. Thank you.
So, in conclusion, there are still fake issues which Muslim jurists have raised. Firstly is takaful agreement is an akad al-mu'awadah. Secondly is the issue of wa'ad, which is promise. Thirdly is the issue of gharar, which is excessive uncertainty. And lastly is the issue of underwriting surplus. Islamic finance and takaful have its appeal for the strong ethics of the system of fairness, transparency, distribution of wealth, leading to social goodness and environmentally friendly, focus for generating economic activity. It discourages creating money from money and hence prohibit interest. So, we have finished presenting about an Islamic takaful. That's all. Thank you.